top on the burner now as the Monetary Policy Committee of the Central Bank. They began the rate-setting meeting. That was yesterday, and today we're expecting the decision at this point. And it's what's before this monetary policy right now. This committee, we've had quite a stable naira, so far, and it's new inflation data with the new methodology for reporting inflation in Nigeria. We did rebase from the last one that we were using before now. So for December, definitely we saw inflation way over 30%, but now we're down at 24.48%. So all of this before this Monetary Policy Committee, what are they going to do next at this meeting? Are they going to raise rates? Are they going to cut rates or maintain status quo? That's the question now. Joining us for this conversation, we have Mr. Tajuddin Ibrahim. He's the Director of Research and Strategy at Chapel Hill Denham. We also have Mr. Kalu Aja. He's a financial expert joining me from Texas. It's good to have you both on the show.
Hey, Ladi.
Thank you very much for having me.
All right, let me start with you, Mr. Kalu Aja. So, looking at what's playing out so far, let's start with the MBS latest inflation data with the rebasement that we had, recently, 24.48%. That's the new data. Does this make the job of the MPC easier, or is it confusing things at this point?
Thanks for the question. It's a curveball because what they've done is they've changed the methodology. Inflation itself has not gone down. If NBS said in the report that they released that the prices of goods have not come down, what they've done is they've looked at the CPI basket, taken food from 51% to 40%. So in essence, we're counting less food in the basket. And because we're doing that, then of course inflation has come down. But the price of increase in food is still up. It's still up at 24%. So if you're in MPC, are you saying because the methodology has changed, does that actually affect the price of rice in the market? That's your question. And if you say the price of rice has gone down, then of course you want to drop rates. But if the rates are still going up, because we look at the trend line, not just the absolute figure, but the trend line, it hasn't come down. So if it's still going up and up and up every month, then you then have to ask yourself the question, if I reduce rates, what am I really doing? Am I reacting to a change in methodology, or am I reacting to a change in the price level? That's the question I'm going to ask today, and it's been interesting to see the answers.
Right, and definitely that question has to be answered, at this point. But let me come to you, Mr. Tajuddin Ibrahim. So, definitely, I know you guys have been, talking a lot and giving out notes about what's playing out with this new inflation data. Is the first MPC decision meeting in 2025. What are you expecting?
So my expectation is for the Monetary Policy Authority to keep interest rates unchanged. And when I say keep it unchanged, I mean the monetary policy rate being kept at 27.5%. There are some reasons around that. Number one is that we now have an inflation rate that looks smaller than the monetary policy rate. I understand that what has happened is a mere change of methodology, and it does not necessarily, translate into much lower inflation rates. But the reality is that from now on, the old series are gone. It is the new series that the authorities and even the financial market will be referencing to make economic and investment decisions. So what this implies is that you are going to see everyone taking a look at 24.48% as Nigeria's inflation rate for January. But I think that is not what the Monetary Policy Committee should focus on. I think they should reflect on the development in January. When you take a look at January inflation, which is 10.68% compared to the base, in December, when they did the rebasing. So it is important for the Monetary Policy Committee to see a couple of months, like over the next 3 to 4 months, to really understand the trend of the newly rebased CPI before they can make concrete decision around possibly cutting interest rates. But I think a safe decision for them would be to hold the rate constant today.
Right, and looking at this new the inflation data for January, that's 24.48%. We have MPR at 27.5%. I did talk about this yesterday. So we have positive interest rate for the first time in a long time. But how are your investors? How are they reacting to the inflation data? Is it making your job, harder? Advising some of your clients in where to pile cash at this point?
Honestly, it is making my job a lot easier because as at the beginning of the year, we had communicated to investors around the world that Nigeria this year most likely will be witnessing lower inflation rates. Not necessarily because the movement in the increases in the prices of goods and services have slowed down. It is not that those movements have really slowed down. It is just that there is a change of methodology. And when there is a change of methodology, the market reacts very quickly. If we look at the beginning of the year, we already advised investors to expect lower inflation rates and hence lower interest rates and lower yield on investments this year. And the strategy that really will have played out was for investors to front load on fixed income investments and money market investments at the beginning of the year. And it's reflected in the Nigerian Treasury bills results of yesterday, where we had the swap rate come down significantly, particularly the one-year yield came down to about 22.5% thereabouts. So which is now a situation where we have a much lower yield on 1 year instruments compared to previously 25-26% yield that we were witnessing in the market. So it is reflecting in the market. The market is reacting quickly. Because the case of introducing new methodology to measure the CPI is like a case where the authority of the country introduces a new currency note. When a new currency note is introduced, that is what everybody takes a look at, and the old currency note becomes illegal to be transacted in, and nobody really wants to look at all of those anymore. So that is the reason I reckon that the market and the authority should be looking at the month-on-month change in the newly rebased CPI, how it plays out in the next 3 to 5 months. No doubt the market is reacting to the lower inflation by pricing in lower interest rates on fixed income and money market instruments.
Investors actually beat inflation, with most of the investment. But let me come to Mr. Kalu Aja now. So we have more data out, and this time it's money supply. Broad money supply, that increased in January 2025. We're at 110.98 trillion from January 2024's 94.61 trillion. That's about 17.3% increase in money supply. We've had over about 850 basis points hikes so far from the Monetary Policy Committee, trying to tame inflation and mop up all of that excess liquidity. But we see the money supply, keep going higher. Talk to me about how the MPC would, see this new data. That's for Mr. Kalu Aja.
Yeah, I think the reality is that spending has not reduced in Nigeria. Forget about the prices. Spending has not come down. We spent about $2 billion in December 2024 to finance the 2024 budget. That's still in the market, right? So the petroleum prices are still up. So if you go to the man on the street, he's still spending at the quote-unquote 34% inflation price today. And that's what you see this drive through liquidity in the market. There's too much cash in the economy. There's less productivity in the economy. That's what's going on. And then when you now say you are rebasing the inflation rate, what you've done is that you are talking only about the market itself and not the economy. So the market will react and say, yes, inflation has come down, NPR is still up. There'll be a reaction in the financial market. But the economy is where we're now going to be looking at and say, okay, will this translate to a fall in prices in the Nigerian economy? And that's the question that your guest is saying. We have to then watch what happens next month and what happens the month after. Inflation used to be driven by food. Now it's just 40%. Let's see what the new methodology would bring. If we then see inflation in Nigeria going down officially, but prices of energy, the core, energy and food, keep on going up in Nigeria, there becomes a disconnect, and people might not then trust those numbers that are coming from MBS. So we've got to watch it here. We can rebase the inflation to zero by saying we just want to measure, say, for instance, MTN cards. But the reality is that the economy and the market are two different pathways, and they've got to basically talk and align with each other.
What do you think the CBN can do at this point? Because, we've seen all the mopping up activities, so far, but it seems it still keeps increasing. That's money supply. What do you think should be the strategy, in 2025? So we can see reports of money supply actually going down in the economy.
Well, honestly, I don't think the CBN has a lot of ammunition, or should we say options. It can only raise rates, it can increase monetary policy numbers, CRR. It can do all those, what we say, the fundamentals with the banks. But Nigeria is still largely a cash economy. Remember what happened when we tried to go to a cashless economy and the economy almost ground to a halt. So the CBN really has to ask itself today, we've done inflation targeting, and we have kept growth muted because the SMEs can't borrow at the rate we have today. Is it time for us to sort of pivot and say, let's also look at growth? Let's also look at targeted credit to core sectors that drive job creation in Nigeria. Because all we've done in the last year is to chase inflation. The MPR has not caught up or reduced inflation. The CBN is now behind the ball in that the statistics guys have said we are going to change and bring on inflation. For CBN's numbers, the trend line is still up. So CBN has to ask itself, should we pivot now towards growth because we're not going to catch inflation? They might catch it now because that is 24. But even at 24%, really, which SMEs can borrow at this 27% MPR rate? So that's really the question for me. Do we do growth or do we still do inflation targeting? And if we do that, what happens to the economy? Remember, we're chasing jobs. We're chasing a $1 trillion economy in about 5 years, 2030. And all those things have come to play with lower rates so that SMEs can borrow, create jobs, and grow the economy.
All right, definitely. We're trying to, create jobs at this point, and it's not looking very easy, with the way we're seeing things right now. But let me come to Mr. Tajuddin Ibrahim now. So definitely there are new numbers, and we have a decision coming up today for what lending rate to be. This is the first one for 2025. What do you think will happen to most of the stocks trading today? How do you think investors are going to react? Mostly, we've seen investors mostly shrug off, most of the rate hikes. In other climes, when we see rate hikes, we see stocks get hammered. So, Mr. Tajuddin, are we seeing more positivity for the stock market here?
So I think the way to look at it is to even stand from the standpoint of the connection between the financial market and the economy. So now that we are having the market reacting positively to the lower inflation rate, what it implies is that corporates will be able to borrow money at relatively lower interest rates, because we have some corporates in the pipeline that most likely will be bringing to the market as Chapohit Dynam to issue commercial papers to fund their businesses. Those businesses will be funded at much lower interest rates, which implies that CP rates most likely are going to go down. When businesses are able to borrow from the financial market at much lower interest rates, it translates positively to the economy, because it means that from that standpoint, the cost of borrowing is coming down. So we expect that to begin to play out from like the month of March onward. In terms of market reaction, I reckon that the market most likely is going to react positively. I'm speaking to the stock market in this case. Reacting positively implies that the market will be viewing it as the cost of borrowing for companies coming down. And most likely the beneficiaries would be non-financial stocks. Non-financial stocks because we know that the banks, generally speaking, like high interest rates because that is when they make huge money on loan disbursements. That is when they make huge money on investment in government securities and other investment, excuse me, assets. So it is not really good for the banks from that standpoint, but it is good for the cement manufacturers, the consumer good companies, the healthcare sector, because they should be able to tap into the financial market to get capital, either short-term or long-term capital at relatively lower interest rates compared to what we had last year. So from that standpoint, it is positive for the stock market.
The fixed income market.
So the fixed income market, it is also positive because what it means is that if you were to mark to market your fixed income instrument, it means you now have much lower yield. And when you mark to market, you have higher prices on the current holding of your investment securities. And then you have more profit in that regard on a mark to market basis. Where the downside risk is for the fixed income instrument is that new investment will be booked at much lower interest rates, and that will imply lower cash generation over the next sort of 6 to 12 months for such investments. But no doubt on a mark-to-market basis, it is a lot of money for fixed income investors because when they sell, they'll be selling at much higher prices because yields are now getting depressed as we speak.
Thank you for that, Mr. Tajuddin. Well, Mr. Kaluaja, so most of the international investors I've spoken to recently, most of them have talked about like this is the best time for Naira assets. And we've seen some of them actually say they're going long, on Naira assets in 2025. Mr. Haja, do you share this sentiment? Do you think, with what we've seen so far with the Naira, do you think it's really time to hold Naira assets in 2025?
Well, if you look at a report came out yesterday, if you look at all the asset classes in the world, i.e. from, say, US stock market, Japanese bonds, everything, the best performing asset class today is emerging markets, stock markets, then commodities. So when you are buying Naira, that means you're selling dollar. Essentially, that's what you're doing. So everyone is looking at what's the dollar doing. Rates in the US are coming down. So if you then want to get that yield, you've got to take more risk, which is there. You're going to look at emerging markets. When I mean emerging markets, not Nigeria for now, but the developed markets. But again, it rubs off on Nigeria because if Nigeria is paying you 8% via the dollar and the US is giving you 2-3%, going back to 2-3%, and of course Nigeria becomes very, very attractive, even with that risk that Nigeria has. So if you want to buy at a quote-unquote discount, because the Naira is still trading at, say, 14 or 1500, Nigeria looks like a discount through earnings, through the exchange rate. But then you are buying that systematic risk of Nigeria, i.e. once you get in, then you are in Nigeria, and then you are now exposed to the issues that occur in Nigeria. But in terms of attractiveness, Nigeria looks cheap right now when you compare to what you might get if you go outside the country. So that could answer your question. Globally, assets are moving away from developed markets towards emerging markets, equities, because of course the US, the inflation has come back down in the US, so fixed returns in the US are not offering you that 4, 5, 6% that they were offering, say, a year or two ago. So it's cheap. If you want to take the risk, Nigeria looks like a cheap option for you right now.
What do you think this will do for domestic investors? With what we're seeing with the data change for inflation, with the rebasing. Do you think investors in Nigeria, they're going to have it better, in 2025 than, previous years?
It really depends on what. See, the good thing with Nigeria right now is that the budget looks, because of Dangote, if we are able to cut that spending that we're using to import PMS, that frees up the government to, say, reduce its deficit. If they reduce their deficit and they do not borrow, then interest rates in Nigeria start to come down a bit. If there's more fiscal discipline on the government side, it allows the private sector to really roam and the animal trade to just take control in Nigeria and then create these jobs. We need to get foreign direct investments into the country. We need to get the infrastructure working. So we need positive news. We don't have to build the railways yet, but we need that positive news that folks are coming to invest in the country, remittances are going up, naira is becoming stronger. That's what's going to ginger the enthusiasm for folks to bring out cash from the fixed income, from the dorm accounts, and invest in the real sector in Nigeria. There's tons of cash just lying in banks, lying in CPs, lying in bonds. It needs to come out of those instruments and go into the real productive economy to invest in infrastructure, to invest in trade, to create jobs, and then to boost consumption at the local level. If we don't do that, then we might not have missed that train on really growing the economic base of Nigeria.
All right, thank you so much for that, Mr. Aja. But let me come to Mr. Tajuddin now. Are you seeing good news coming? Good news that could, catalyze the markets more for Nigeria in 2025?
Well, I think some of the good news that can catalyze the market is that we see sustained stability of the FX rates. Once we have stability, we are positive that foreign investors will be interested in this market. And if you also consider the fact that with stable exchange rate as we speak, and also elevated yield on investment, the carry trade for foreign investors is still robust. We have a case where our 1-year treasury bill is about 22.5%, 5% yield. And in the US, you get not more than 4% or thereabouts. So the carry trade is still robust at around 18% or thereabouts. So my sense is that even if there is a cut in interest rate in the coming months, most likely we will see the foreign investors liking Nigeria in terms of the carry trade, because the carry trade coming down from 18% to 10% is still decent in my view. So we expect that to continue to underpin the way foreign investors play these markets. Corporate results most likely will be announced, from next month to April. We expect those numbers to be robust for the banking sector. We expect those numbers to be convincing for the consumer sector from a recovery standpoint. Now that we have, stable FX rates, most likely the final quarter of last year for them was a strong one. The cement manufacturers most likely will also be reporting interesting numbers. But let me come back very quickly to the Monetary Policy Authority. I think there most likely will be a need for them to adjust the asymmetric corridor, because we now have a situation where the lending facility rate is now lower, is now around 26.5%. And instead of banks to now go to the T-bills market, where we now have yield being lower, I think that rather would be going to the CBN's window to deposit. So the CBN is paying more than what the market is willing to pay. There may be a need for the Monetary Authority to take a look at that corridor in that regard, in my view.
All right, thank you so much. Well, about 2 p.m. today, we should be able to get that decision. That's the first one for 2025. What's the lending rate going to be? Will it be a hold? Will it be a hike? We'll definitely find out. But thank you so much, Mr. Tajuddin Ibrahim, Director of Research and Strategy at Chapel Hill, Denham, and Mr. Kalu Aja, a renowned financial expert. Thank you both for coming on today.